right. Welcome, everybody, to the CRE Spotlight. We have a very special guest. We have Rick Rule, legendary natural resources investor, serial bank startup, helping bank startup, former president of Sprott, which was a publicly traded company on the New York Stock Exchange, supposedly semi-retired, but still running Rule Investment Media. He's got virtual boot camps about natural resource investing, and he just recently had his Natural Resources Investing Summit in Boca Raton, Florida. Welcome to the show, Rick. And let me just say, this is a real pleasure. I've been a big fan for a long time.
Well, the feeling's mutual. I've enjoyed your social media posts and visiting with you. So the admiration is mutual. And thank you for allowing me to visit with your audience. I appreciate the opportunity.
Yeah. Oh, thank you so much. Really excited to talk to you today about EverBank, which has been an organization for longer than either of us expected. But just for our audience, we wanted to ask, what led you to help start another bank in your soft retirement phase of your life?
Well, I think banking is a very good business from my own point of view. That is to say, when I look back over my career, one of the things that I've been best at is a used money salesman. I help people invest. And a banker is nothing more than a used money salesman. It's important then that you focus on what the function of a used money salesman is. Somebody who aggregates other people's deposits and invests them better than they might be able to do themselves, generating a yield for savers at the same time facilitating access to capital for borrowers who deserve it. I also think that banks fulfill a very useful role in society, which is why they're so immensely profitable if they're done well. And for my entire time in business, which is now 50 years, there have been holes in the market as far as I'm concerned, in terms of banks discharging their obligation to depositors and to borrowers. And being an entrepreneur, if I see a hole in the market, I'm viscerally incapable of not trying to fill it. My own circumstance currently is that I'm a customer with a very large international bank and also a large Canadian bank and also a very large U.S. big box bank. And I would describe my own relationship with all of those institutions as sullen. And I'm a very good customer. My relationship with those institutions, if those institutions cared about me, should be ecstatic as opposed to sullen. With EverBank, which was the last bank that I backed this team on, the vast majority of their customers had a relationship with the bank that was either very satisfied or ecstatic. And I think we can do that again. There's some fairly obvious things that banks do wrong from the point of view of both depositors and borrowers. And I think we can address all of that. We won't attempt to be all things to all people. We won't attempt to be all things to all people. We're not going to have branches. Your cell phone or your computer is going to be our branch. If you aren't either temperamentally or psychologically capable of having your telephone or your computer be our branch, you're not the right customer for us. We're not going to be able to service you. But if you are, we are, as a depositor, going to make your life much better. If you are a borrower in industries that we understand or come to understand, we will be better lenders. We aren't going to try and fill our portfolio model with a certain asset class that we don't understand, that we discontinue in 18 months. We intend to be all-season bankers for people whom we can really be of service to.
Wonderful. For our audience that's not familiar with EverBank and Frank Trotter and the team behind EverBank, if you could just give us a little bit of the EverBank history, because it's quite phenomenal what you guys did over a 14-year run.
Yeah, you'll notice I'm smiling. That was a wonderful memory. A good friend of mine, David Galland, one of the best marketers that I ever met, came to me at the end of the decade of the 90s. He'd built up the Blanchard Mutual Fund Group from $0 to $2 billion. the Blanchard coin business from zero to the biggest, numismatic business in the United States. He then became partners with Doug Casey and ran a very large, newsletter business. And he said, Rick, I want to go into the distance banking business. I want to use the internet and direct mail to revolutionize banking. And I said, well, that's great, David. What do you know about banking? And he said, well, there is that, not much. And so I introduced him to a guy who had been my banker, Frank Trotter, who had been an enormously successful regional banker out of St. Louis, had in fact invented, from a practical point of view, foreign currency denominated CTs for retail savers. And I put the two of them together. We had a long strategy session in 1998 on my living room floor using butcher paper to construct spreadsheets. And out of that was born BattleBank, the idea that for sophisticated consumers, that there was a better way to bank, that the branch banking network didn't offer very much value either to the institution or to the savers, and certainly not to the borrowers. And that by eliminating the branches, we eliminated about 125 basis points, 1.25% of the cost, non-interest expense of banking, which could be passed on to the depositors. We figured out, too, that the proliferation of deposit products available to retail customers in the United States was mostly subterfuge. That product differentiation didn't exist to benefit different classes of customers, but rather existed to baffle customers and, in fact, cause them to pay hidden or not so hidden fees or reduced interest charges. And we, very early on, decided to eliminate the difference between savings deposits and checking deposits. We instituted a high yield money market account that you could write checks on, but it also paid you to save in. We went from 15 deposit products to 1. That did two things for us. It reduced our costs by a whole bunch because we didn't have to explain 15 products that shouldn't exist to a customer. We explained one product. It also helped the customer because they didn't have to try to understand 15 products, 5 of which, by the way, purported to pay you no interest. That was, at the point in time that we did it, a real breakthrough, honesty in banking. The second thing that we did is we figured out that in an economy the size of the U.S., that there were people who didn't want to have all of their savings denominated in U.S. dollars. Perhaps there was a Canadian business person who did business both in the United States and Canada and needed to maintain deposits in the United States in Canadian dollars and U.S. dollars, and needed to be able to transfer funds between Canadian dollars and U.S. dollars more cheaply than the Canadian banks would do it. So we instituted foreign currency denominated money market funds and foreign currency denominated certificates of deposits. This ultimately became an $8 billion deposit product for us over time. The most amazing thing, Andrew, is that without really knowing how we were doing it, we became a very large mortgage originator. We did it not because we knew about mortgages, more about mortgages than anybody else. We did it because we built up a 200,000 depositor base who liked the experience of doing business with us. And they began to ask, do you do mortgages? In the beginning, the answer was, well, yes, of course. Very quickly, it became, yes, sir. We absolutely, positively do mortgages. And as a consequence of treating people well on the deposit side, we became very, very large mortgage originators. Not because we led with mortgages, because we led with service. We built that bank in the period 1999. I guess the bank opened the doors in 2000. 2014, we grew the bank from zero, which is where most banks start, to $28 billion in AUM. And the bank was sold to TIAA-CREF, a big annuity and retirement plan sponsor. They had tried for many years to craft an online banking platform for their 1.5 million members. and had been unsuccessful. And so they bought both our platform and the $28 billion in deposits from us for, if my memory serves me well, 2.7 or $2.8 billion. By that point in time, of course, we'd gone public on the New York Stock Exchange. We were no longer a private bank, but we enjoyed 14 years of really marvelous success by the old-fashioned simple expedients of looking after our customers, looking after our depositors, and looking after our borrowers. It hasn't been tried by many banks for a very long time, but I assure you it was highly successful. TIAA bought a bank to serve their purpose, but as a consequence of having 1.5 million members, the innovative deposit products and the innovative borrowing products that made EverBank special were of less interest to them. And they began to drift away from that towards using the platform to service their own members, an entirely understandable transition. But what happened is that they left the 200,000 customers that we brought them in limbo. And beginning about 2016, I started getting emails from people who I had introduced to EverBank saying, I'm still with I'm still with EverBank, but EverBank isn't with me anymore. They've moved on. It took the customers about 4 years to talk me into helping reassemble the old team, but the old team is back with some crucial differences. We started EverBank with an idea, but no customer backlog. The people who have signed up for the waiting list of EverBank, BattleBank, pardon me.
No worries.
They're not really interchangeable, but I in my imagination, I use them interchangeably. 10,000 people now have said, we want to do business with BattleBank. We're ready when it opens. We want a bank that pays attention to us as depositors. We want a bank that pays attention to us as borrowers. There are two other critical differences. One is that for the first time that I know of in the United States, there will be a bank that exists to make collateralized loans against individuals' precious metals holdings. If you hold gold, silver, or platinum and palladium in safe storage, in segregated storage with Brinks, Loomis, or Viamat, and perhaps with other depositories as well, we will make a credit facility available to you. You don't have to borrow it, but you can borrow it. If you don't want to sell your precious metals, but you need access to liquidity, we will provide that. We think gold and silver are good collateral. Most institutions can't spell gold or silver. The second thing, and I think this will be of particular interest to your audience, Andrew, we believe that your IRA is your IRA. And we have learned that we can construct an IRA that owns an LLC, and that LLC can invest in a whole range of so-called permitted activities, which include the ownership of owner-operated real estate, meaning that a BattleBank IRA can own a single-family residential rental, or a duplex, or a fourplex. It can, in certain circumstances, own a franchise or a small business, owner-operated. I love the idea that your IRA is just that. Too many times, IRAs are really repositories for financial products originated by financial institutions. They exist not so much to serve the customer as to facilitate the distribution of the institution's product. In the case of BattleBank, your IRA is your IRA. Within the limits of the law, you decide how you want to invest it, and we facilitate it. If, Andrew, you chose to buy a single-family residential rental or a duplex or a fourplex, and you were looking for a first mortgage, of course, we would prefer that you started your search with BattleBank.
Yes.
The people who introduced you to the idea about how you might own this real estate. But that isn't a necessity. We don't exist to force you to buy all of our goods and services, although, of course, if we treat you well in one aspect of your portfolio, we would like to cross-sell you to another.
That is outstanding. So just to recap, one thing I think some people might miss is just the value of having one single high yield money account where you can write checks and still get a high yield. I think is going to be very attractive. Is, you know, myself, I just recently had to pull a bunch of money out of savings into checking because I had written too many tax bills, which is another subject of contention. On the gold part, some of my friends get a little confused. So if we could go into just the kind of mechanics of it, who would hold the physical gold to be lent against, from you guys?
Gold, which is held in segregated storage, which is to say it isn't in a common pool that has been relent by your bullion dealer, but rather, let's say, Andrew, that you bought $1 million worth of gold and you bought it through a dealer. I don't care which dealer. You bought it through a dealer, and the dealer is storing the gold on your behalf at Loomis, Brinks, or Viamat. I say Loomis, Brinks, or Viamat because I don't want to lend against gold that's held by Schlepp, Schmuck, and Schmo somewhere above a gas station in Topeka. I want a vault that's controlled by a public company so that I could read the audited financial statements so that I know that your gold and my collateral are safe. And although I trust these institutions, the essence of trust is verification. I want the storage facility audited on a regular basis so that both you and I know that your gold, my collateral, is still there. If you do that, the gold stays in your possession. It stays in the same relationship, but we have a UCC filing on it. We have a lockbox, which means that if you sell your gold, before you get the money for selling your gold, I get my loan repaid.
Oh, okay.
Now, this turns out to be spectacular collateral.
Mhm.
Gold in system, in good delivery, is easy to value, and it's really easy to sell. If you need access to it, it's not an illiquid piece of real estate. It's not something where the value is subjective. The value is established second by second by second, and it can be bought or sold in a nanosecond. It's actually the ideal collateral if you can structure the lending agreement in a way that gives maximum flexibility both to the borrower and to the lender. And we've done that. I've known a lot of people who believed, as I believe, that gold is in effect the ultimate insurance policy, at least the ultimate form of liquidity by way of insurance. But if you aren't willing to make gold liquid, it isn't liquid. And so often people will have a large proportion of their net worth in gold, but they will need to access some liquidity from time to time, and they don't want to sell their gold. This gives people the ability to do precisely that, make that gold a tool that works for them right now, as opposed to over time.
And what would be the LTV that you're looking at, and how, would the credit line be a variable interest rate?
Yes, it will definitely be a variable interest rate. Think of this as a margin loan. So at the time that the loan is established, the loan to value will be 50%. You can go up to 70% if the gold price were to fall precipitously without a cure. If you borrowed $1 million, if the loan to value became 70%, which is to say the value of the gold fell to $700,000, you would have 5 days to cure, which means that you either have to sell the gold or you have to contribute enough cash to bring you back on side. Like any other margin loan, at 90% loan to value, you're sold out. So really think of it as a margin loan.
Oh, okay. It's not really a credit line, it's more of a margin loan.
It's absolutely a credit line if you want it to be.
Oh, okay.
You can pay us a very small facility fee so that you don't have to borrow against it. If you do borrow against it, it's a drawn credit line.
Oh, okay.
We've noticed, we haven't noticed. I noticed for myself that while I have no intention of borrowing against my gold, it is useful to have access to credit if an opportunity presents itself. I've been lucky in my life that from time to time, opportunity has presented itself, and I've had the ability to avail myself of that opportunity. And so this product was really designed with me in mind. But I know that there are hundreds of thousands of others like myself who have stored wealth in precious metals. And the reason that they have some wealth is because when opportunity has presented it, they've been able to take advantage of that opportunity.
Okay, great. It's in everybody's mind with the big bank failures like SVB and Silicon Valley, other banks that have been failing. What's different about Battle Bank for our audience to listen? Because I know you often speak about the way you're going to capitalize the bank and your lending policies, you're much more, and the word's thrown around a lot, but you're much more conservative about the way a bank is run.
Andrew, it took real skill to screw up Silicon Valley Bank. It took exquisite skill to screw up First Republic. Now, First Republic had one thing going wrong. They had all these branches. When they were servicing people that were competent enough not to need branches. But that wasn't their primary problem. Their primary problem was the same thing that brought down the U.S. savings and loan industry. They borrowed money on an overnight or now basis, and they lent money long. They tried to take advantage of the interest rate differential, time value of money differential between short-term deposit and long-term lending. It's okay if you do that if you move the asset off your books. In other words, it's okay if you're a bank to write 30-year fixed mortgages. It's just not all right to keep them. If you're funding a 30-year fixed mortgage with a liability base that's overnight or 30 days, you can't take the time value of money risk, the credit risk, or the interest rate risk. You have to move the deposits off. And so at Battle Bank, while we will certainly write first and second mortgages, fixed rate, we will sell those after we've originated them. We will so-called mature them, meaning that we will collect 3 interest payments so that the buying institution will come to know that the borrower is credit good, money good, and then we'll sell them. We will lend money on a floating rate 366-day basis, where we'll roll the loan over if the loan is in good standing at the end of 366 days. But we won't expose ourselves to rising interest rates by lending money long-term in the fixed rate. What brought down both Silicon Valley Bank and First Republic Bank is the mismatch on duration between assets and liabilities. By the way, according to the most recent reports I've read, some of the biggest banks in the United States, including Bank of America, have moved so many fixed rate obligations to held to maturity rather than held for sale, that if they did not do that, the mark to market on their long-term liabilities relative to their assets, or relative to their equity, pardon me, means that they're technically insolvent. They are allowed not to mark those assets to market by moving them into an asset category called held to maturity, where the regulators have deemed that because they plan to hold this mortgage, as an example, for 30 years, they don't need to take into account the reduced value of the mortgage as a consequence of higher interest rates, and they're allowed to carry it on the books at par, as opposed to what it would sell for. That's not something that we're going to do. It's not something that we did at EverBank. We are going to match duration and match margin for long-held assets and short-held assets. The second thing is that by conventional measures, we're going to be overcapitalized. The FDIC suggests that a well-capitalized bank has equity as 7% of total assets. I'm an old man. I prefer 10. I'm not saying that we will always be at 10. There may be a point in time when there's a financial panic, when nobody else is lending, where we will draw our equity down to 7% to take advantage of the financial distress of our competitors, with the idea of building it, of course, back up to 10.
Is there any? Oh, go ahead.
Go ahead. Go ahead.
No, you. I just wonder, is there anything else about Battle Bank you wanted to talk with us about before we kind of go to more investment mindset questions that we have for you?
I just think that what we learned at EverBank was a really amazing lesson. If you build a constituency by serving them better and intelligently, and then you listen to them, you ask your constituency how it is that you can serve them better. One of the things I've learned, Andrew, in 5 decades in financial services, is that rich people are very generous in giving you information as to how you might serve them better. Remarkably generous.
Okay.
And what we learned at EverBank is by listening to the customer, listening to what products and services they needed. As an example, beginning to build a mortgage business from our deposit base, that a really truly customer-centric bank, in addition to having an obligation to educate its customers, has an absolute obligation to learn from them. We were able to do that at EverBank. I was able to do it at Sprott. The best product ideas we ever had at Sprott, and certainly most of the good ideas around my conference, didn't come from me. They came from my customers. And if there's ever been an important lesson that I learned in financial services and that EverBank learned in banking, it was build a unique customer base because you serve them better with regards to one of their needs, and then listen to them as to how you might service them better in other needs. An existing customer is easier to attract and easier to service than a new customer. And never, ever, ever forget that fact.
All right, wonderful. We're going to go to some investment mindset questions, but we're going to remind everybody that Rick is very excited to be rid of all his FINRA licenses and certificates. So this is not investment advice. This is just educational and between friends, across the internet, but between friends. And it's not investment advice. One of our first questions that we often discuss, so some of us, that talk to investors have a hard time explaining to people, is cash is not trash, in the sense that there's going to be, we think, great opportunities for investment. Like you were reflecting earlier, when bad times come, those that have the strength and conviction to utilize their capital are going to be the ones that actually have the capital. How do we get people to see cash as an options premium for dry powder when, on the other hand, they're hearing, cash is trash, inflation is whatever we think it is, and you're losing money every day? How do we convince somebody that holding cash isn't crazy?
Andrew, I remember in 1992 being at an investment conference with a dear friend of mine, Doug Casey, truly a unique human being. And I remember Doug saying from the podium, cash is trash. we were in a panel, and I grabbed the mic and I said, Doug, if that's so, give me yours. I know you well. I happen to know you have a lot. And I remember the immediate chuckle I got out of Doug Casey. Now, why did he chuckle? And let's talk about cash. I'm delighted that you gave me the chance to answer this question, by the way. It's one that I teach a lot in the classes where I mentor younger investors and business people. It is true that holding cash costs you money on a current basis. If you were to invest in 6-month T-bills, you're probably getting what, 5% now? Mm-hmm. The CPI stated rate of inflation is now what, 3.8? But the CPI is a lie. The CPI, as an example, doesn't include tax, which is the largest household expense for most working and all successful Americans. When I, in a rough sense, look at the deterioration of the purchasing power of my savings, I say that inflation, measured by the deterioration of purchasing power of savings, is running about 7%. So I save money at 5%, and the value of that money goes down by 7%. I'm losing 2% compounded, which is where the phrase cash is trash comes from. But I will draw the attention of your listeners back to 2008, where some of them were present and cognizant, but others would have to study historically. I came into 2008 with a lot of liquidity, having experienced periods of time earlier in my life when I had no liquidity. The consequence of having the liquidity, Andrew, is that I had the tools and the courage to take advantage of a circumstance where other people didn't have liquidity, and where some of the people who did have liquidity didn't have the courage to take advantage of it. What that meant was that 2009, which was a horrific year for most investors, was, in percentage terms, one of the best investment years of my life. I was able to take advantage of the distress of others, including in your field, real estate, in a way that hasn't occurred since. I didn't know how and don't know how to add value in real estate. I had to be a passive investor in real estate. But because I was willing to partner with very, very good operators at a point in time when nobody else was, I was able to place money, place liquidity in a way that was enormously advantageous. What I came to realize in 2008 was precisely the way that you led off the question. The 2% a year that savings cost you in real terms is an options premium on having the ability and hopefully the courage to take advantage of periods of illiquidity when other people are taken advantage of. Warren Buffett said that that discipline and that opportunity was the most important factor of his success in building net worth.
Oh, that's great. Okay. Kind of related, but we're going to ask you to retell a story that I've heard you tell once before. How do people move forward despite all the bad press in the news? It's very easy to say, this isn't a good time, and I'll just wait it out. And it's almost an excuse not to do the research, not to do the mental work of looking for bargains. And if you could tell the harbor story with I think it was your grandfather who had told you as you were walking by with the boats in the harbor, would you mind sharing that story and discussing that issue?
Either I told the story wrong or
Oh,
you
okay.
wrong.
Well, I apologize. Maybe I'm
Yeah.
misremembering it. The idea that boats are safest in the harbor, but they're meant to go out to sea. And when you go by the marina, all the yachts and the nice boats, those are the people that put capital at risk. The risk takers are the ones that own the yachts, I think.
Let's use a different parable. Michael Jordan.
Oh.
Somebody asked him how he scored so many points. He said, I took a lot of shots. And he said, every shot I didn't take, for sure, I didn't score. I've heard so many times in my career, I can't get ahead because Trump, or I can't get ahead because of Biden. Well, neither Trump nor Biden know that you exist. Using them as an excuse for failure is a guarantee of failure. And the truth is, despite all the challenges in front of us, humankind in the very long term just gets better and better and better. I look back over my career, and I've always been cautious, perhaps because of my political stance. Andrew, I joke that between Doug Casey and I, we have correctly forecasted 17 of the last 3 recessions. What I've learned is that once every 10 years or once every 15 years, there's a liquidity crisis or something that cuts the price of most stuff by half. By the way, it doesn't impact the value at all, just the price. Doug Casey says, a bear market doesn't change the value of assets, it just changes who owns them. That's important to recognize. And when I look, as an example, at the 1987 market collapse, one I remember very well because I got married 2 days before it. Seemed like a harbinger. Or the 2000 tech wreck, or the 2008 crash. They were dramatic to go through, really dramatic. And if you look at the impact of those crashes in a 50-year stock chart, or a 50-year chart of GDP, or any reasonable measure of economic activity, you almost can't see the declines, Andrew. It turns out that the risk of being not exposed ends up being much greater than the risk of being exposed. If you took an index, my favorite general equities index is the Dividend Aristocrats ETF, an ETF comprised not of the S&P 500, not of the high flyers, but rather of companies that are sector dominators that have met or exceeded their dividend forecasts every quarter for 30 years. If you look at that plain Jane, mundane, vanilla index over 50 years, dividend included, what you'll see is that the punctuations, while dramatic, that involves market declines over decades, didn't matter at all. If you are financially prudent, which is to say your capital stack isn't so debt heavy that you can't meet their obligations when you come true, and if you maintain sufficient liquidity, first of all, to service your obligations, but also to take advantage of circumstances when others can't. But you stay involved in the market, irrespective of what your market is, through thick and thin. If you add value by buying 12-unit apartments, when the opportunity comes to buy a well-located, well-maintained 12-unit apartment that you can add value to without taking so much risk that you imperil your existing portfolio, do it. Absolutely, positively do it. If you are waiting for that opportunity to become more attractive to you as a consequence of a market decline, what's going to happen is a more aggressive operator is going to come in and grab it. And you are going to be left saying, I coulda, woulda, shoulda. I hope that helps.
Oh, it does very much.
I have learned with the correct capital stack, being out of the market is much riskier than being in the market.
I'm going to lead you a little bit, but I always love the pogo reference. What is the biggest risk to investors? I often tell them that it's themselves, but I borrow that from you quite a bit on my LinkedIn comments, but maybe you could elaborate a little more articulately than I do in my brevity.
Well, certainly with regards to me, the author of most of my investment misfortunes has been myself. And they come in all shapes and sizes. I've been doing this for 50 years, so I've made a lot of mistakes. The pogo reference comes to Pogo in the Swamp, saying, I have met the enemy and he is us, meaning that we're the authors of most of our own misfortunes. I say that most investors' principal risk is conveniently located to the right of their left ear and to the left of their right ear. But all those references are the same. Undue fear of issues that are less relevant that you can't control anyway is one. That's been my biggest mistake. Being out of the market because I didn't agree with the political circumstance, or I read too many inflammatory headlines. Newspapers seldom say all is well. They can attract many readers by saying that. Earlier in my career, fear of missing out, which is to say there was a sector that was drawing a lot of attention. I thought I had to be in the sector despite the fact that I knew nothing about the sector. So fear of missing out on an opportunity that I wasn't placed to capitalize on was certainly a mistake. And related to that is deciding what you like well enough and where you add value enough and sticking to your knitting. I've been very, very, very lucky as a real estate investor, but I understand that I'm not a real estate operator. I don't know how to add value relative to people who can. There are people who know how to add value in real estate. There are some people, I know a couple of them, who instinctively can look at a house and say, if I do this to it, I do that to it, I do something else to it, that house will have value for a buyer that isn't expressed in the current market. I don't know how to do that. I know a lot about how to analyze oil wells or mines or timberland or farms. I know a lot about how to buy water rights. And I find that the farther I get from activities where I outcompete other operators, the greater the probability that I fail is. The consequence of that is that in my declining years, or at least in my retired years, I invest in natural resources and conventional financial services. The two businesses that I've been successful in for 50 years. Stop.
So no producing movies ever again.
Nope. There was a time, that's another mistake I made. We could do a whole show on mistakes. There was a time when I had been very successful, particularly in natural resources, and other people and myself came to believe that my skill set was transferable. That is, because I did well in mining, because I did well in oil and gas, because I was self-confident, reasonably intelligent, that those business skills were transferable into other sectors, including, as you suggest, motion picture finance. I learned a rather ugly lesson getting out of my area of expertise. I found out just exactly how smart I was, which is to say, not very. When I got back into areas where I outcompeted, I did very well. I learned a second lesson, and I need to acknowledge this. After I got married, I've always been competitive, and I always aspired to be at a place where I didn't have to look at the right side of the menu where the prices are, almost irrespective of what consumer good was on offer. And so I was focused on money, and my wife almost slapped me. She sat me down and she said, "Stop worrying about money. Start worrying about organizing your life in a way that gives you joy, where you can outcompete other people, because when they work, you go to play. In other words, where it's so much fun for you, where you do it so instinctively that you can add value. You already have enough money if you live a fairly modest life. If you worry about economic activities that express your value, if you worry about adding value, the money will take care of itself." And Andrew, I can't tell you how fast that worked. Certainly within a year, when I stopped focusing at all on making money. I'm not trying to say that I went to work for the United Way or something like that. But when I started worrying about how to make money for my customers, is about how to make money for myself, my business didn't grow, it exploded.
It's amazing. That's great. Okay. There's more questions I'd like to ask, but some of the questions we'll do it at a later time, because uranium would be its own podcast entirely, and oil and gas would be its entire podcast itself. But since we have just a little bit of time left, if you could do me a favor, there's many Rick Rule clips that I share, or stories, but my favorite joke by far is your owl bond. So since we were talking about black swans and the potential that there could be another great buying opportunity, if you could tell the owl bonds joke.
It doesn't have to be limited to bonds. It can be any illiquid financial asset. The case of the owl bond came from my early experience in the 80s in high yield or junk debt. And an owl bond was simply an illiquid bond that when you went to your broker to sell, your broker would say, "Too-hoo, too-hoo."
I just love that joke. That's really one of my favorites.
It's a lesson that I learned ruefully personally, and it's one that stuck with me as a consequence of that.
Yes.
You could certainly extend it to a piece of junk real estate, one where you haven't improved it enough that there's a market for it. Any illiquid asset in a bad market becomes an owl asset, which is to say, what used to be your asset becomes your liability.
A lot of people read books, and there's a million books out there, but what are the book recommendations that you have for investors? I know the answer, but I'd love to have our viewers hear it from you.
Well, that list is really expandable, but I'll give 4 that I always ask people to start with. The first is Economics in One Lesson by Hazlitt. Anybody who had to suffer through university economics spent 3 or 4 years learning how the world doesn't work, how the big thinkers would wish that it worked. Economics in One Lesson is a small book. It's an easy to read book, so the return on effort is very high. And it explains how the economy, and hence how economic relationships, material relationships between humans, actually works. It's a great foundation book. Give it to your kids. I've been part of giving away over 100,000 copies to young libertarians around the world through Students for Liberty and the Atlas Foundation. It's that important a book. Once you've begun to learn how the economy works, and you want it, you want your piece of it, I would encourage reading something called The Intelligent Investor by Ben Graham. It was the seminal work that started Buffett on his way. Ben Graham is, I think, the greatest teacher of investing relative to the effort required to understand his message that ever lived. Pay particular attention to the chapters around mode of safety, both in terms of what you invest in and constructing your own portfolio, and Mr. Market, which is to say the necessity to be a contrarian. This is the best investment book ever written relative to the effort required to read it. The reward is high, the effort is low. If you like that book, then read the best investment book ever written, which is Securities Analysis, also by Ben Graham. If you read securities analysis and employ the lessons, remember, if you employ the lessons, you will become rich. You will become materially rich. You cannot help but become rich if you employ the lessons in securities analysis. If you want to understand why those lessons work, then for me, the granddaddy of all of these books is Human Action by von Mises, an exploration into volition, which is to say human will and incentive. Those listeners of yours who read it will spend some time cussing me because it's a very dense book. It's very hard to read. It was written in turgid German and translated into more turgid English. If you don't read the topic sentence, you won't understand the paragraph. If you haven't understand that paragraph, the paragraphs that follow it will be mysterious to you. But the most impactful book I have ever written, my apologies to people who prefer the Bible, the Quran, or the Torah, is Human Action by von Mises.
Before we wrap up, do you still do your special offer that usually you end every interview on?
I'm delighted to do it. The offer goes like this. If you care what I have to say about natural resource investing, sidebar, please no REITs, please no pot stocks, please no tech stocks, please no cryptocurrency, natural resource stocks. If you go to ruleinvestmentmedia.com and you list your natural resource stocks, I'll personally rank them. No charge, no obligation. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value to you. If you are interested in what we're doing with the bank, in the question and comment section at Rule Investment Media, write bank, and I will put you on the waiting list for Battle Bank.
Well, thank you so much, Rick. I just really wanted to thank you for your time, and this is really a thrill for me. So thank you so much.